Shares of DoorDash here trading higher, up just about 5.5% after the company posted results that were actually pretty impressive here, at least to the street. Revenue up 40% on a year-over-year basis to $1.82 billion. Orders also rising 27% from a year ago to 467 million. Let's talk about it, what this means here for the company going forward. And for that, we want to bring in our guest here. We have Nikhil Devnani, a Bernstein U.S. emerging internet research analyst. Nikhil, it's great to have you here. So first, just your reaction to these results. We also got a new president, new COO, and a new CFO. So 2 new changes in the executive suite as well.
Yeah, absolutely. And first off, thanks for having me on. I think the initial reaction is that overall results were pretty solid. What you see is that this business continues to hum along and grow at a pretty steady pace. You mentioned it there with the order growth. That top line is growing north of 20% on an organic basis, which is not something a lot of people would have expected when you kind of rewind several months and everyone had fears around what the post-COVID world would do to this category of consumer spending. And turns out consumers continued to really like the service. They added more customers. They added more DashPass subscribers. So I think increasingly food delivery is becoming more and more of a habit for the average American. And I think the other factor here, too, what everyone wants to see in this market is really profit margins expand. And they gave us the hope of that as well with their 2023 outlook, pointing to growth in adjusted EBITDA, likely a little bit ahead of where the street was coming out. And so that was really nice to see as well.
Another example of the consumer just continuing to spend through everything we've seen. So, Nikhil, you say humming along. How are they doing so in comparison to their biggest competition, which is Uber Eats? And do they have a competitive advantage in that regard?
Yeah, I think what we're seeing is that, DoorDash and Uber are both growing at a pretty steady and consistent pace. Depending on who you trust, either one might be gaining a little bit of share here or there. But by and large, both of them are growing at a pretty healthy clip in this kind of mid-teens to 20% type of range. And I think what we're seeing is that these are the two scaled players in the market. The entity that's losing out more is Grubhub, which tends to be kind of the share donor in the space to both of these platforms. And I would argue, DoorDash is probably the best position in the U.S. because it does have that scale advantage already. It has the best selection. It has the highest penetration of subscribers who just love and use the platform so much more frequently than everybody else. And that continues to pay dividends, and you can see it in the results here.
And they moved into Europe with the Wolt acquisition. Many are very concerned about the potential for drivers to get these raises in New York, where there are an estimated 90 million deliveries every year. How big a problem could that be for Q1, Q2 down the road if, in fact, that goes into effect?
Yeah, I think it's likely to go into effect, and it's going to probably happen in the second quarter. So, the rule is being reviewed as we speak, and we'll likely get something in the next couple of weeks here. It's going to change the nature of food delivery in the city. It's going to make it more expensive to order. It's just what happens when you kind of raise the pay thresholds for drivers. But I think what we're likely to see is that these platforms will do what they can to operate it away. What I mean by that is you try and batch as many orders as you can together. And I think whatever they can operate away, you'll see it be passed through to the consumer. And I guess the consumer has to get ready to foot the bill a little bit more on some of these services. And maybe some consumers will take issue with that, and you'll see a little bit of churn as a result of it. But I think for these platforms, what they've realized is that it's too expensive to eat all of the cost burden themselves. This is a very difficult business to run. And I think on the margin, when things like this happen, you have to just lean into the price and elasticity that you have and pass it on and take it there. And maybe it hurts growth a little bit. But I think the stickiness of this service is what these companies will bank on.
Yeah, the Uber CEO was not overly concerned with that on their most recent earnings call. Nikhil Devnani, really appreciate that. Thanks so much.
Absolutely. Thank you for having me.